Thank you very much, Adam. Es freut mich sehr, heute einen Vortrag bei Ihnen halten zu dürfen. Eigentlich sehr, da ich in Berlin in den 90ern hier gewohnt habe. Und wenn Sie Fragen haben, können Sie auch die Fragen bei der BIR-App eingeben und ich werde so viele Fragen wie möglich am Ende beantworten. Good. So not to make everybody run for the door and pick up the translation things, this will be in English. Just wanted to, say a couple nice things. I lived in Berlin in the 1990s, and a lot's changed here, and a lot of things have, of course, changed with the financial market since then. I'm going to go through a number of different things as we talk about the outlook for Ferrous markets in a climate of global economic uncertainty. So before we get started, just a couple of housekeeping things. First, there's a disclaimer. I'm sure you'll read it diligently. Basically, it just means if you want to quote or use any of these graphs or things, you have to come and talk to me afterwards first. This is maybe more for the media and stuff like that. And the other thing I just want to mention, you've heard about our rankings and things. These are our current rankings from Bloomberg. They're issued once a quarter. These are from April of 2016. So number 1 in the world for copper, number 3 for all industrial metals, 3 for precious metals, 2 for the U.S. unemployment rate and euro-pound exchange rate and some other stuff, like number 1 for oil. So we'll talk about all these different things. People ask me about forecasting. The reason I put this up is I want to share my view of how all of these things fit together and what it means for Ferrous. And we've heard already some pretty dismal things, so allow me to pile on and begin with a quote. We're not technically in a crisis. This was the response of an IMF, one of the heads of research at the IMF last month in their press conference when they released revised growth forecasts lower for most economies in the world. And in the press conference, somebody said, well, are we in a crisis right now? And this was the response, well, we're not technically in a crisis. This was followed up by the equally inspiring statement, we're on alert for a crisis. That's where we are right now in the global economy. If we want to see where growth is, and I know these are smaller charts, so I'll read off some of the big numbers that matter. You can see all the numbers in red under 2016 and 17. Those are the numbers that the IMF lowered last month. And by the way, these lowered numbers came a week after Christine Lagarde, the head of the IMF, did a TV interview with Bloomberg Television. And Francine Lacqua asked her in a series of interviews, in a 3.5-minute interview, came after Lagarde had given a speech in Frankfurt, different questions about the economy. And it was before these forecasts were released. And Lagarde was asked explicitly, are you worried about risk of recession? Not once, but twice. Now, if you're the head of the IMF, and someone asks you're worried about risk of recession, there's really one right answer. And the answer is, no, not at all, not at all. Nothing to see here, just keep moving, right? But that's not what happened. The question was deflected twice, and instead, Lagarde highlighted 3 big concerns that she was looking at. And the first is the transition of the Chinese economy, which the Chinese GDP forecast, though, for this year was raised to 6.5, but that's number 1. Number 2, low commodity prices, and specifically low oil prices. And number 3, the risk of contagion for financials. And she didn't use that word contagion, but she said the risk to financial services sector. Those are the big 3. And those are 3 things that I've been concerned about for a while. I know Autumn mentioned my book, Recession Proof. It came out the end of February. Those are the exact same 3 reasons I signed with a publisher last August to get a book out about a coming recession. I'm more concerned about a modest U.S. recession, but what Lagarde said last month really highlights the risk of a global recession. 2 caveats with these numbers. Last year's global GDP forecast from the IMF, or the actual reported number they have right now is 3.1. Their forecast for this year is 3.2. 2 things. 1, it's generally considered acceptable that if global GDP growth is 3% or below, we're technically in a global recession, right? It's not like the way you might have learned about it in economics class. It's 2 consecutive quarters of negative GDP, blah, blah, blah. Nope. If the global economy is growing at 3% or below, global economy is probably in recession. Number two, the IMF is notoriously rich in their forecasts. In other words, they're always revising them down. And their current forecast is 3.2 for this year. So the odds that we end up below 3%, pretty good. Now, this industry is much more attuned to these things than a lot of other industries. And I'm going to talk about a lot of other data that backs up what y'all are seeing firsthand. But I think it's the data we've just seen, especially about some of the trade data around scrap, really highlights the slowdown in the global economy. Now, the number I'm going to come back to a lot here, as Bill had noted in his welcome letter that I think you all have, the conversation around Ferrous begins and ends with China. And right now, the conversation with everything pretty much begins and ends with China. And that 6.5% GDP number that's out there is pure fiction. Let's talk about why. So right now, there is an ongoing Chinese manufacturing recession. Now, the 6.5%, don't worry about that, right? That's just not real. Let's talk about something that is. Every month, there are purchasing manager indices that are collected. What is a purchasing manager index? Well, there's people who work at factories who buy stuff. They turn that stuff into other things that get sold into the market. These are purchasers. And you ask these people every month, are you buying more this month or less, right? It's a pretty easy question. And you aggregate it over hundreds or thousands of different companies. Now, this is really important because if a purchaser is buying less in a manufacturing setting, that means they're going to be producing less, which means there's less demand on the outbound, right? So, for the Chinese PMI, there's a government one, but there's a private one. The private one is now the Caixin PMI. It's released usually on the first day of a month or the first business day of a month. And for any of these PMIs, I've got three up here. One is for the US economy, that's the ISM. That's the one in blue. The one in green is for the Eurozone, and the one in red is China. For 16 of the past 17 months, the Chinese PMI has shown contraction in manufacturing. Month after month, it's been getting worse. That doesn't just mean there's a recession going on, especially if it drops like it did, say, for April. That means that you might actually have a worsening recession. For the ISM, which is the US number, it bounced in March, as did the Chinese PMI, and it pulled back in April, as did the Chinese PMI. Now, in America, what I hear from a lot of folks is how weak the European economy is and how weak Chinese manufacturing is. But for 9 of the past 10 months, Eurozone manufacturing has been improving at a quicker pace than US manufacturing. And for 5 of those months, Eurozone manufacturing was improving while US manufacturing was contracting. So I have bad news for you if that's your perspective. If you think that everything is great in the US, it is not. Manufacturing is actually in a worse position than it is in Europe. And some of that has to do with the central bank cycles, and all of this has to do with what's going on with the dollar and commodity prices. And I promise you the most important data points you could watch from now until whenever will be these monthly PMIs. Because when I'm looking at monthly commodity price moves, you get a pretty good idea a month ahead what's going to happen based on the PMIs that come out at the beginning of that month. Really important to watch. I can't say it enough. Because this is real data that's compiled from private company surveys. Now, one of the reasons the conversation begins and ends with China is because it's a critical consumer of commodities, right? And how much? 54% of the world's aluminum goes through China, 45% of the world's steel, right? And if you're looking at galvanized steel, whatnot, you might 48% of the world's zinc goes through, and 50% of the world's nickel for stainless. And it's not just for domestic consumption, it's throughput for the global economy. So if China's weak and China's demand for these metals are weak, it's not just because the domestic market of China is weak, it's because the throughput demand has weakened. So that was Lagarde's point number one, worried about China. And by the way, something else I'd point out, for the ISM Manufacturing Index, that blue line, if it's below 48.5 for 3 consecutive months, the last 3 times it happened was in the Great Recession in 08, in the 01 recession, and the 3 months immediately before the 01 recession. It also recently happened in November, December, and January. Just a few months at a certain level, and the odds of a recession go up a lot. And that's in an economy in the US where manufacturing is only 13%. In China, manufacturing is 31% of the economy, and it's been in recession for almost a year and a half. There's no way that economy is growing at 6.5%. Number 2, oil and gas recession. So let me drop some knowledge. One of the major wire services wrote a story about this, what I'm about to talk about, and only 50 people have read it to date. On November 5th, the Fed, FDIC, and OCC, which is the Office of the Comptroller of the Currency, issued a joint statement about the Shared National Credits Review. Now, for those of you who aren't American-based, these are 3 regulatory agencies that have oversight over banking and lending. And the Shared National Credits Review is when they look at all the debt in the United States. The title of this report was Shared National Credits Review Notes High Credit Risk and Weaknesses Related to Leveraged Lending and Oil and Gas. In my opinion, this is the most important piece of regulatory warning we've seen this entire cycle. And on one of the major wire services, 50 people have read that story to date. I had 8 calls with 8 funds in the first 10 weeks of the year. Big funds with lots of money in oil and gas. One of them even knew about this warning. This warning came out on November 5th, 2016. If you look on my Twitter feed or my LinkedIn, you'll see I was writing about it. This is a really big deal because it says, you can't read the numbers maybe in the back, what it says is oil and gas bad debt went up almost 400% in a year. That's what it says. So that's bad, right? But it gets worse. The day the warning was issued was November 5th, 2015. On that day, the closing price of WTI was $45.20. That price was 30% higher than the price in the first quarter average, right? So the first quarter average, 30% below this level. And by the way, almost 6 months were we below that level. And yes, oil prices have risen. And yes, we're near 50 bucks. But it took us 6 months of burning through lots and lots of OPEX and losses to get there. I would also point out that prices now are artificially high because of some special disruptions like the Canadian oil sands fire and some terrorist activity in Nigeria, or militant activity, however you want to describe it. But again, what's really important here is a few weeks ago, like 3-4 weeks ago, we just got back to, yes, oh, it's higher, and you might read this in the general press. Oil prices are back up. Things are great. We are just now back to the giant, huge red flag warning level where the Fed, the FDIC, and the OCC wrote a warning to banks. What this really says is, dear banks, don't give any more money to oil and gas. Love the Fed, the FDIC, and the OCC. That's what this says, okay? We are just now back to that price level. Just now. To give you some idea what the details look like, there's been about 17 billion year-to-date, or just through the end of April, bankruptcies in the oil patch. They accelerated through April. The year-to-date, again, through the end of April, equal to the total, almost equal in value of 17.1 billion of the bankruptcies in all of 2015. So about 1/3 the year covered all of what last year's was. And in terms of all corporate defaults, this is all global corporate defaults, and this is from S&P, through the end of April, there were 50. Now, 75% of those were in the US, but there were 50 global corporate defaults. In 2009, there were 90. We're on track to have 150 this year. This is why Lagarde highlighted why oil and gas is a risk and why there's contagion risk for financials. This is a really big problem. Again, we're just now back to the warning zone. You're reading the press, oil prices are up. They are. They're back to dangerous because they're still too low. I would also point out, of course, there's the other half of oil and gas. There's also natural gas. And on the day the warning was issued, the price was $2.36. In the first quarter average was 20% below that, and we're still nowhere near that price now. So depending on how you want to weight the carbon, we're still kind of, again, at or maybe a little below where the danger zone is if we weigh oil and gas together. So that's part of the problem, but there's other stuff going on too. Now, part of the reason Eurozone manufacturing has been doing a little better than the US for almost a year is because the central bank policies are going in different directions. While the European Central Bank is still engaging in accommodative stimulus with a quantitative easing program, the Fed is actively talking about rates. And this has kept the dollar strong, and I'll talk about the dollar in a minute. But first, let's talk about the US industrial recession that's going on right now. I'm going to show a series of charts. We're going to go quickly through these because it's early in the day and there's no bar at the back of the room. So I try, and some of these are small. What you need to know about this slide, this is a recession of investment. And if you look, there's a small red box in the middle that covers three numbers. That's the total gross private investment in the United States, not just business investments, all investment for the last 3 consecutive quarters. They're all negative. That is a recession in investment. Corporate profits. You'll see a number of these graphs. They're from Fred. Fred's not some guy. No, Fred is the Federal Reserve Economic Database. These graphs are great. And the gray lines you see show recessions. And what you'll see is the level of corporate profits we're at now is similar. The only time you've had similar negative levels in this entire period since the 1940s, and you were not in a recession, was 1986. Capacity utilization. Oh, that's at recession levels. The ISM, which was recently below 48.5 for 3 months, that's bad. We're a little better now, but we're likely to drop again for May. Again, that number comes out this week. Big deal. Watch the ISM, watch the Chinese PMI. I'll talk a little bit about why later. Durable goods orders, those are negative year over year. We saw in March they were quite weak. There was improvements in the total number in April, but in April, the ex-transportation number remained at minus 1.4%. Let's talk about some rail traffic, right? We're interested in rail. The purple line here at the bottom of the graph that's below all the other numbers is the current level of total rail traffic. That's all carloads and intermodal rail. Lower than 2013. If you want to know where coal's at, this is coal. Coal rail loads are 50% of what they were just last year. You're talking 60,000 carloads a week compared to last year around, last year's was around 100,000 at this time, and in 2014 was closer to 120. Metallic ores and minerals, that's also quite weak. For the first quarter, we've been, the average running total has been below the other time series here, but they're not as bad as that coal recession, which is just absolutely miserable. Material handling. Prestige Economics produces proprietary monthly index like the PMIs for material handling, which is the circulatory system of the U.S. economy. That's anything that moves stuff. It's a $350 billion a year in revenue industry in the United States. And it contracted for 2 consecutive months in March and April. Shipments activity contracted for the first time since we started collecting the data last June. In April. And of course, if I were to show you the unfilled orders, you'd find that unfilled orders have contracted for 3 months and inventories are going up. And this is the equipment that helps move things through the economy. Not just big industrial stuff, but anything that moves, including retail consumables. And we'll talk about those in a minute, now that we're in recessionary data that goes beyond industry. So maybe you've heard about this industrial recession in the United States. I gave a presentation about a week ago to a large public company that specializes in material handling equipment, and the CEO came up to me after the presentation and said his board didn't believe him, that there was a manufacturing recession going on. Of course, he had my deck then. I said, show that to the board and let me know how it goes. There's a lot of bad charts here. So let's talk about some other stuff. Retail sales, right? Maybe you've heard the U.S. consumer's really strong. The U.S. economy is going to be just fine because the consumer's doing great. Well, this is year-over-year retail sales, and what you see is that the level we're at now is pretty close to what happened in 2001, and that's all retail sales. The minute you strip autos out of the equation, it looks bad. It's worse than 2001, and it's worse than 2007, right? We're talking like it's actually worse than 2008 levels even. So this is the worst year-over-year rate of retail sales other than 2009 that you see in this time period. This excludes autos, though. Autos are the linchpin for the U.S. economy right now. The number of cars sold in 2014 was 16.4 million. The number of cars sold last year was 17.4 million. 1 million extra cars were sold last year, just like trucks, cars, and SUVs. 1 million extra. Talk about why in a minute. Retail sales growth, and this is some of the monthly numbers. They've recently bounced, but still at recessionary levels. Housing starts, that's at a recessionary level as well right now, even though it's recovered. I'm sure you've heard that housing starts has improved and things in housing in the U.S. are better. But if you look at this graph that goes back to the 1950s, you'll see that the level of housing starts we're at now is still a recessionary level of housing starts for every business cycle except 2001. And the reason 2001 was different was because of all those subprime housing loans, which leads me back to cars. So we expect this year there's going to be a drop in auto sales to 16.9 million vehicles, which is a lot, but it's a lot less than 17.4 million. It's 500,000 less. And of course, cars are what held up retail sales at all last year. And there's some things we're going to talk about with that. We'll get back to it in just a second. There's also a recession of confidence going on. And we see the level of consumer confidence we're at is near recession levels. And as for the timing of the next recession, we do a quarterly survey of our own clients. 2/3 of them see a U.S. recession in 2017. Now, we see the dollar likely to remain strong. But part of that is because the Fed keeps talking about raising rates. Now, it's been a really interesting couple of weeks. Janet Yellen gave a talk on Friday and indicated that the Fed was almost ready to move. It might be a couple of weeks. I personally saw the president of the Dallas Fed speak on Wednesday to a group of 30 of us in Houston. And the things he said, it was closed doors, so I can't exactly say what he said, but generally, we're in line with that kind of notion as well. And that's very surprising to me, and I think that will be surprising to a lot of people in financial markets, because I also received an email this week from another central bank, and it's one of the big ones, and it's one of our clients. And the question, very short email, why is the Fed talking about rate hikes? The strong dollar is one of the things really weighing on the U.S. economy right now, really weighing on manufacturing. It's affecting commodity markets. It's affecting equity markets. And yet the Fed has very ambitious rate hike expectations, and they're still talking about them. What are the forecasts now? What you see here, March 2016, forecast once a quarter. The Fed produces these forecasts. And the current forecast is that for March of 2016, it'll be 1%. Or the March of 2016 end of year 16 forecast will be at 1%. But they've lowered that forecast at 6 consecutive meetings. Back in September 2014, they said, but for the end of this year, it was going to be at 2.7. And the forecasts for the end of next year are still at 2, and the forecasts for the end of 18 are around 3. So right now, based on the Fed's quarterly forecast, the most recent ones for March, they're saying interest rates for the Fed funds rate are going to be at 1% at the end of this year, 2% at the end of next year, and 3% at the end of the following year. Our baseline scenario is that we slide into a U.S. recession by the end of the year, Q4 of this year or next year. Modest recession. I envision not a great recession. I envision more like what happened in 2001, right? This is a more normal cycle because essentially commodities were the bubble of the late 2000s and 2010s. Right? Too much money lent into a space. Valuations come in because the underlying assets are lowered, and when you peel back the valuation onion, there's just less inside. For the U.S. economy, this also looks like 2001, because in 2001, two of the big triggers that set off our recession were Enron and WorldCom. And right now, in addition to shale, I'm also worried about unicorns. For those of you who aren't as into tech stuff, unicorns are the billion-dollar-ish companies that essentially have no revenue. And if you begin to peel back the onion, you find there's nothing inside. For a U.S. downturn, the good news is these are mostly privately held and not public. The other good news is this isn't consumer debt driven. This is more on the corporate debt side. So it looks more like a normal recession rather than a great recession. But we see the Fed cutting rates by next year. We see the unemployment rate going up next year and going up in 2018. And we see a recovery into 18 and beyond. There are other long-term challenges. We'll talk about that in a minute. But I'm very concerned that if the Fed raises rates in July, I don't think they'll do it in June because of the Brexit risk. I personally don't expect a Brexit. I think it's really exciting to talk about. I think it sells, if you watch the general news media, I think it sells a lot of toothpaste and toilet paper. You know, people want to watch the news, but I don't think it actually results in a real Brexit, right? And I think it reminds me a lot of the Scottish referendum or any of the votes out of Greece where, oh my gosh, it's the end of the world, it's the end of the world. Oh, no, it was just a really interesting story that the media pushed. And so I'm just saying it seems a lot like that to me. I mean, Winston Churchill was the guy who, after the Second World War, envisioned a United States of Europe, right? This is his baby. So this seems very strange to me. And I also believe that although the voting masses, right, are subject to all kinds of de Tocquevillian problems, right, the tyranny of the mob and that sort of thing, but I also believe they're wildly self-interested. And while a Brexit would hurt Europe, and a Brexit would hurt the US, and a Brexit would hurt the global economy, a Brexit would really, really, really hurt the British economy. So I think that people are aware of this, and this is going to affect how they vote. So let's talk about the dollar for a minute here. So anyway, so the Fed's likely to hold off in June, and I go to a bunch of Fed things, and I was at one at the beginning of the month, and I was talking to one Fed official, and he'd said, you know, Fed really wants to raise rates badly. Yes, they really do. They're concerned about inflation. They want to raise rates. But this dollar thing is such a problem, right? We recently there's two blue lines here. The blue lines at the top and the bottom for this dollar chart represent the range the dollar has been in since January of 2015. That's the top and the bottom. And we recently broke below the bottom of that range, and that's technically significant, but I'm not going to bore you with technical stuff. But what I want you to know is that even though we're kind of in the bottom-ish of this range and we've bounced up a little bit, if we look at a long-term graph, this is a monthly chart, you see that the dollar is still near 2003 levels. It's the strongest it's been in 13 years. And if the Fed raises rates, they're just going to make the dollar go back up to the upper end of this range. And then that slows manufacturing further, that hurts further business investment, that hurts our trade balance, and then you get that recession even quicker. As for the euro, you can see it tested. You can see where there was a little spike through its blue line that it's been in the same range since the beginning of 2015. And it wasn't able to close on the other side of it, and it's since pulled back. The euro is going to be pushed around by the Brexit stuff, by what the Fed does. But fundamentally, the Eurozone economy is on more stable footing than the US economy. And that makes me, which is a shocking statement to say, I know. This, I think, will continue to cause the euro to strengthen in coming quarters. So let's talk about some energy price risk stuff. I'm going to go through just a few quick things here. Now, you probably don't think too much about natural gas, but this is actually a really good illustration for what we could think about with, say, ferrous scrap or with oil prices, and I'll tell you why in just a second. This is a long-term graph of natural gas. It goes back, it's monthly prices, and you see there's a drop here in 2012. Over here you can see that drop towards the far left side of the graph. And at that time, that was partially shale gas. And at the time, people thought, well, everybody's going to pull back their spending. Gas is going to go back up, which it did. And now it's lower than where it was back in 2012. Now, some of that is weather dynamics, and some of it's der Schweinezyklus. Now, in America, we don't have a great way to describe this. People call it the commodities cycle. But this very specific German term, der Schweinezyklus, is so great. It translates roughly as the swine cycle. And this is an illustration from my first book, Commodity Prices 101, right? So the price of pork rises, so everybody wants to breed more piggies. And then the price of pork falls, right, because everybody's got all these hogs and piggies. And then, of course, since the price is low, no one wants to raise hogs. And then, of course, the price of pork rises because there's no more hogs. And the cycle begins again and again and again. And in a shale environment, as long as you have access to capital, this kind of works. So oil, for now, is likely to go higher, but we think there's going to be a short-term pullback, but remain in this range or higher by the end of this year and higher at the end of next year from where we are now. And eventually, when the money comes back, when the Fed, the FDIC, and the OCC allow more lending to happen in this space, or encourage more lending, or don't discourage it, perhaps we could say, you're going to eventually get more drilling that becomes very responsive to price. And this then makes both oil and gas very much more like agricultural commodities. And we'll talk about this in just a second. But crude oil production, this is in the U.S. You can see the blue line. It's dropped by 430,000-ish barrels a day since the beginning of the year. But during that time window, Iran has increased their production by hundreds of thousands more than that. Ferrous prices. So steel prices have been rising on a trend, and it's been quite sharp. And I know we've taken a look at the ferrous scrap prices, and I'll talk about those in a second. We've seen this really, really sharp rise, and I'm very concerned that this might not be stable, right? I'm very concerned because there's a few things going on. And I've got some data here from Bloomberg. If you look at the output, if you look at the orange line here is China monthly steel production, and the white line is the rebar's futures price. And this is just through April. You can see that production level has been soaring, and it's following prices higher. That's not a good sign. And of course, the margins now, after having collapsed at the end of 15, were really wide. That gap's going to close real fast. As for iron ore, you've seen those prices pull back. Again, you had this artificial jump and then a pretty big pullback. Ferrous scrap prices, those spiked and collapsed. We saw, Bill showed us a number of different prices. I watch the busheling contract because it's traded on the NYMEX. I like exchange-traded commodity contracts when we can find them, although it's quite thinly traded. And, this is, pretty surprising to me where the price goes from, $245 a short ton to $395 a short ton and drops back to $260 or it goes from 250 to 395 and drops down to 260 in the course of 7 weeks. This is a lot of the huff and puff where I think you're seeing money rotate into the space that Bill had alluded to, where there's some funny stuff going on in this market. And this is not fundamental. If we put it on a long-term chart, you can see how that's really not fundamental, right? That's problematic. So this is definitely the huff and puff kind of stuff. This is also, I think, why iron ore is falling, and I think steel prices are likely to come behind it. They might not fall as drastically, but I do believe they'll fall. Another analogous market to think about is coal. Coal is 85% correlated with Chinese GDP. Coincidentally, iron ore is also 85% correlated with Chinese GDP. They're not correlated with each other, but they're both correlated with Chinese growth. And this market has been decimated, it's low, and the prices are seeing only modest increases. A few other markets I want to mention briefly. Copper prices. So for those of you who might watch it, those who watch the health of the Chinese economy often refer to copper as Dr. Copper. And what you see here, again, you have these bounces in price and then a collapse. The blue line, the blue diagonal at the bottom, was a support line. There'd been a trend there since January of what you'd say higher lows, and it broke right through that. Right, so oil prices are up and steel's up, but scrap did a huff and puff. Copper's got something similar going on. You did what they call a double top here and then fell through the bottom of it. Aluminum prices, they were trading pretty strongly for a while. They had a huge surge in April, and then the prices collapsed. And you know what sent this price down at the beginning of May? And this price down at the beginning of May? That weak Chinese PMI and the drop in the ISM. Those PMI reports at the beginning of the month, super important. If the numbers that come out this week are better than last month, these things will go up. But I don't think they're going to be better than last month. I think the Chinese PMI and I think the ISM that come out for May will be weaker than April. And it's going to be very tough for these prices to rise in June if you have an even deeper Chinese manufacturing recession and the U.S. economy comes even closer to a manufacturing recession. As to our price forecast, even though we see a pullback in steel, we do see some propensity for prices to rise later in the year. We think things will be more dicey next year as the U.S. slides into recession. You're talking about an average hot-rolled coil price of $546 this year and $563 next year. Iron ore around $60 this year, $63 next year. Ferrous scrap $326 this year and $330 next year. So average price is pretty flat, but I think what you're going to see is lower prices at the beginning and middle of the year. Prices get higher later in the year. They're a little elevated at the beginning of 17, and as the U.S. recession kind of becomes more full-blown, they come under more pressure next year. A couple other things I know I'd alluded to with U.S. auto sales I want to talk about briefly, because I know that's a big source of ferrous demand, or ferrous supply, rather. The first is that subprime auto loans are largely responsible for, well, not largely, but it's a big chunk of why auto sales have gone up so much in the past year. There are now currently in the United States more subprime auto loans than there are subprime housing loans, right? More subprime auto loans than mortgages. Now, you don't need them to blow up, right? We don't need to have happen what happened in the last cycle. You don't need them to blow up. Let's just say the banks reduce the new issuance, which seems highly likely because the Fed, the FDIC, and the OCC are concerned about some of the leveraged lending that's been going on at the banks. So if they reduce the lending, you reduce your auto sales. If you do reduce your auto sales, that's how you get a recession. I would also note that every year, U.S. and other manufacturers that operate in the U.S., they have lease fleets. So they sell large amounts, well, they lease large amounts of cars, and they go out for a couple of years. For those of you from the States, I think a good analogy would be a cicada brood, right? So you lease these cars, they go out for 2 years, then 2 years later they come back. Well, 2 years ago, the number of cars that were leased in the United States was 3 times the normal lease fleet, 3 times the normal brood. And the large auto manufacturers that I advise are not expecting good things for the next 18 to 24 months. You have a lot more cars coming back in. One of the automakers has now created a new certified release program in order to be able to release these leases. What it does is it hurts new sales. And that's really one of the few things holding up the U.S. economy. There's one other thing I want to point out in terms of what's going on with the Fed, the FDIC, and the OCC. Earlier this month, I was one of 100 economists invited to a dinner. It's held every year by the Atlanta Fed. There were 4 sitting Fed presidents in attendance out of 120 people, and one recently retired Fed president. And Bill Dudley, the president of the New York Fed, spoke. And in his speech, he mentioned the importance for banks to increase their capital, right? To increase their capital reserves. This isn't, the interest in X reserves. This isn't anything to do with loans. This is how much capital they have to keep liquidly on hand. Right? So if you tell the banks you need to keep more cash, you can't lend out as much, and you need to keep it liquidly in cash, that's a rate hike without even raising rates. But the reason they're doing it isn't because they want to get around the rate hike thing. They're doing it because they're concerned about all of the other oil and gas companies that will go bankrupt this year. Because that's not over yet. It's far from it. I confirmed this last week in a conversation with the president of the Dallas Fed in a presentation he gave. This is a real thing. I've now heard 2 Fed presidents talk about it. It's a real thing, guys. And no one is talking about it at all. It's not positive, especially not if you're raising rates at the same time. So let's talk about the upside and downside risks for the economic outlook. On the upside, the Eurozone is experiencing modest expansion. U.S. job gains, those have been solid. I didn't talk about the job market, but the unemployment rate's been going down. It's around 5%. We think the report this Friday will be between 125 and 150,000 jobs. Unemployment rate probably go down a little, 4.9, but we're probably at the bottom for the cycle. And the total U.S. economy has been expanding. But as I showed you in the recession slides, investments in recession. And as you might have heard, net exports, the trade component, is in recession. They've had 3 quarters. There's been 3 negative consecutive quarters of trade. Government expenditures are relatively stable. So it's really consumption that's been driving growth. And that consumption is heavily skewed towards autos. Downside risks. The global economy has slowed. China's been in a manufacturing recession for 16 of the past 17 months. And I think the number that comes out this week is going to show it's 17 of 18. Almost a year and a half of a manufacturing recession with, despite all of the different stimulus China is trying to push through, it still looks like a real recovery looks quite a ways off. U.S. manufacturing data contracted for 5 consecutive months through February. U.S. oil and gas has slowed, and the sector was flagged back in November. We saw that chart in the price of oil. The dollar's likely to remain relatively strong, even though I think it'll weaken by the end of the year, and it'll weaken a lot more next year as we go into recession and have to cut rates or do more quantitative easing. It's still going to be relatively high by historic standards. And auto sales, they've been strong, but they're likely to slow. These are all the top rankings that we have. I won't talk too much about this. These are the 28 categories. I actually do all of our forecasting personally. I think it's helpful to have an integrated view on what's going on, and that's why I do all of our forecasting. Number 1 for jobs, all the metals pretty much. Contact info. I'm happy to open things up for questions. I would also say, I know Ranjit and I have been talking about more ways I can get involved with things with the BIR, and there might be an announcement about some stuff coming in a month or so. Looking forward to Amsterdam. So, yeah, but I'm happy to take questions at this point. Thank you.